Okay, good afternoon and welcome back everyone to our options education. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're going to be taking a look at how to utilize, or today we're going to be looking at a live market analysis using OptionsPlay. And what we're really going to be doing is covering what we discussed over the last four sessions, where we discussed everything from hedging a correction to optimal credit spreads, as well as selecting expiration dates and strike prices. We're going to talk a little bit about all of those things in the context of the current market environment. This gives a bit of, for those of you that have not joined us on Tuesday and Friday morning yet, a bit of a preview as far as what we typically do on Tuesday and Friday mornings, where we look at the overall markets, we look at the research, and we provide to you our ideas as far as what type of themes and trades that we're currently placing in our own portfolios. So with that, let's go ahead and get started here. We're going to cover quite a bit here today, but you guys did submit a lot of questions ahead of time. I'm going to prioritize answering those questions on today's Q&A so that we can make sure that we get through as many questions as possible. Now, before I get started, just a quick disclaimer: what we're going to discuss here today is purely for educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, can everyone please bring up your chat window, which is at the bottom of your screen, and please type yes if you can hear me loud and clear. I just want to do a quick sound and audio check. Perfect. Okay, so let's go ahead and get started here. Now, for those of you that are brand new and just joined OptionsPlay, or maybe you don't know what OptionsPlay is, you can sign up for a free 30-day trial using the link that's here on your screen. And I just posted that into the chat window. You'll get access to the platform that will show you here today, the weekly options education webinars like the one you are on here today, the recordings for those webinars, as well as access to the Tuesday and Friday morning sessions to give you a better understanding as to how to navigate these volatile times. There are plenty of other things that's included in your free trial: a free 6-step options trading course, as well as weekly cover call and short put reports, which we are now actually sending out and updating every single day. So for those of you that rely on our cover call and cash secured put reports, just so you know, going forward, these are now updated every single day, not just on Monday mornings. So bookmark that link and make sure you utilize that. So like I said, today, we're not going to be doing any educational events today. What we're going to be spending our time on is predominantly helping you answer your questions that you guys have had and that you guys have submitted. And I'm going to try to answer questions and talk about the market in the context of what we learned here this week. So this month, which is hedging a correction, not necessarily something that we need to be doing right now. However, I think it's very important during these times to prepare for hedging your portfolio against a downside correction. We talked about credit spreads, which is a strategy that we've been using a lot, and I think is still a suitable strategy for the current market environment we are in, considering how high implied volatility is still staying. And lastly, we talked about optimal expiration dates and strike prices. So for any questions regarding selecting expiration dates and strike prices, today is the day to ask those questions. And we have quite a bit of things coming up here in June. We're going to start off June by talking about how to manage option positions, whether you are in a losing position or in a winning position. How do you go about handling it? Talking a little bit about debit vertical spreads. So this month we covered credit spreads. Next month we're going to cover debit spreads. I think that if volatility continues to fall lower, we can start taking a look at debit spreads. This is the theme that we started to talk about last Tuesday and Friday. Volatility is still relatively high, but we certainly see some names where it might make sense to start buying options. Then we'll talk a little bit about more advanced and complex strategies. Now, usually I don't go into too many of the advanced strategies like butterflies, condors, because they're actually just combinations of debit and credit spreads. So if you understand debit spreads, credit spreads, you can really understand condors and butterflies. But we are going to spend a little bit of time talking about those strategies. We'll also talk a little bit about time spreads, so calendars and diagonals, something that we trade quite a bit on CNBC on Options Action, but I don't cover very often here. So we're going to dedicate a little bit of time for that. So this is really more of an advanced I would say, topic for June that we have coming up. And then once again, at the end of June, we'll do this all over again, where we look at the markets together and help you answer your questions. So a lot coming up in June. Make sure that you are subscribed and are able to attend those specific sessions. So before we jump into the things that we want to talk about, I just want to remind everyone, because we're still getting a lot of questions regarding how to access the liquidity and the earnings calendar. These are now available to you at the bottom of your OptionsPlay screen. The links to it are under liquidity and earnings. And this takes you both to the liquidity report, which is extremely important in my opinion right now to understand which symbols are very liquid. As you can see here today, there are about 163 very liquid symbols. We tell you whether it's liquid, what the implied volatility rank of that option is, as well as when the next earnings date is. So if you're trading options, you generally want to focus your attention on these 163 names. Now, anything in the somewhat liquid names are still viable for trading, but it's something that you want to be a little bit more careful. As you can see, there are 277 names. So this list has actually shrunk quite a bit over the last couple of days. So this is one of the things that we keep track of in terms of liquidity, seeing how many liquid names there are. We'll put this in the broader context of where we currently see in the market. And like I said, the link to that is at the bottom of your OptionsPlay tool here, liquidity and earnings at the very bottom of your tool. We use bid-ask spreads to determine whether an option is liquid or not. We look at how wide those spreads are, because when spreads are really wide, that's the market makers telling us that things are not all okay. When things are really tight, that means things are all functioning relatively well. We also have an earnings calendar that's built for you based on liquidity, so you know what's coming up and what's liquid. As you can see today, we have some pretty big names, Costco and CRM, reporting after earnings here today. Those are the two big names. And really not a whole lot over the next couple of days that's liquid, a pretty small list to begin with. And then Tuesday, we have Zoom, Campbell's Soup on Wednesday, and a few other names here on Thursday. So not a whole lot left in terms of the S&P 500. At this point, I think about 96% of the S&P 500 has already reported their earnings. So the vast majority of names that are still going to report are pretty small cap names. You have a few trickling in the S&P 500, but for the most part, you have some pretty small names. So not a whole lot to do as far as earnings plays using options, because if you're going to trade options using earnings, you better do it on names that are very liquid. And there's not a whole lot coming up. So, things are going to get a little quieter going over the next few weeks, which may be good or bad, depending on what type of trading that you'd like to do. But let's start off by talking a little bit about the market itself and where we currently stand. So this month, we talked about a few things. Number one, we talked about hedging a portfolio. I think that is a very relevant conversation to the current market environment. I think a lot of people are thinking, markets continue to move higher, but the economic numbers that are coming out, the fundamentals number coming out, the headlines that you see that you see across headlines around the globe seem pretty bearish at this point, or pretty gloomy, if you will, and doesn't quite match up with where the markets are trading. And I think that I've been getting a lot of questions over the last few days and last few weeks as far as whether it's time to buy puts to hedge yourself against a potential correction. This is something that we discussed in detail. So I highly recommend that if you missed that webinar, that you go back and you revisit that, because we talked about some very important things in terms of what to do right now when things are quiet, when things are stable, when things are steady. What can you do right now that prepares your portfolio for buying protection? That's predominantly selling premium right now, selling cover calls, selling cash secured puts on stocks that you want to own, selling put credit spreads when stocks dip, selling call credit spreads when stocks rally. Use these types of techniques and strategies to generate premium, because if the market starts to correct lower on some type of bad news, whether it's geopolitical news like Hong Kong sparking a new set of protests, or a second wave of COVID-19, it's literally impossible to predict what is going to spark the next potential sell-off. But in the current market environment that we are in, that is the new normal that we are trading in. If you're looking at the S&P 500, The new normal is longer and longer period of what we consider suppressed volatility, followed by extreme violent sell-offs or extreme explosions in volatility. And if you think about what we're currently seeing here, it very much is very similar to what we saw from November to January. Sorry, this is a chart of the S&P 500 for those of you that are not familiar. And I'm sorry that my charts got a little screwed up here. I lost I lost the access to the account that I had all my charts saved in, so I'm trying to get that back. So right now, please bear with me on this fairly simple chart that I have, but it's still pretty, it still does the job here. This is the S&P 500 from basically October, from the November breakout, late October, all the way through February 19th. We had a pretty, I would say, boring market where the market just kind of continued to slowly grind higher. Whenever you had a small dip, that was a good time to buy. Every time you had that small dip, it was a good time to buy. But one of the things that was the hallmark of this type of rally is that every single time the market rallied higher, the momentum actually continued to move lower. So what we saw was continuing deterioration and exhaustion on that final push higher. Momentum didn't confirm that move higher, and then we had the subsequent sell-off. Now, no one could have predicted the magnitude of the sell-off. Certainly the technical analysis doesn't give you, doesn't predict COVID-19, obviously, but you had signs of this exhaustion, and that exhaustion will go on for quite some time until you have some type of news-related event or catalyst that forces some kind of massive sell-off. That is the new norm that we're in. So it's important that when you are in this type of market scenario, that you recognize it and you position yourself correctly for it. And that is two things. Number one, make sure that when you take these long positions, when the markets dip, you do it with limited risk strategies. So selling credit spreads. So we talked about selling credit spreads here last week. And we discussed how to utilize credit spreads to basically take a small or neutral move when things are overbought or oversold. And that's exactly the type of condition that we tend to find ourselves in these days. The market moves a little bit higher, it gets overbought, moves a little bit lower, gets oversold, and you have this kind of whipsaw motion. And we're currently in what I would consider a somewhat short-term overbought condition, which means that we might get a short-term pullback to maybe that 295 level before it continues to move higher. But that it may not look exactly the same as what we saw here from November to February, but as you can see on subsequent rallies, momentum has not really moved any higher. It moves a little higher here, which confirmed that small rally, but certainly doesn't look particularly strong on this rally. So things are very, I would say, it's almost like the market is walking on eggshells here, but what you generally want to do right now is prepare your portfolio, and that is predominantly selling option strategies here. So those are some of the things that we discussed here this month, everything from how to prepare your portfolio with the current market environment. We also talked about selecting expiration dates and strike prices. So I welcome any questions on that front in terms of expiration dates and strike prices. And we also talked about selling credit spreads, which if you think about the current market environment, today might be a day where you might want to sell some call credit spreads to look for a move to the downside. And when you do touch that 20-day moving average, that might be a good time to sell a put credit spread. We're not getting a lot of movement here in markets here. There are some names, specific names that are moving quite a bit, but the sectors, there's a lot of rotation going on. You know, earlier this week, financials took off, and now they're the weakest sector here today, besides energy. So we're seeing a lot of rotation. Technology was really weak starting off the week. It's still pretty weak right now. It is not rallying along with the rest of the market. Markets are up. S&P barely up today, basically turning on, had a pretty strong opening and then really weakened into the close. So we see a lot of rotation, we're not seeing things trend very clearly, but we are finding a lot of opportunities where if you look at individual names, like here's just an example, Snapchat, when it pulls back to that 20-day moving average, you get a very nice ricochet to the upside. Same thing with PayPal. Earlier this week, just touched the 20-week moving average, and then you had a very nice push to the upside. Granted, that push to the upside didn't last very long, but that is the new market environment that we're currently trading in. These trends that you have these quick trends that last just a few days long, so you have to be very sensitive to timing and getting in very quickly. But we've seen a lot of them. Same thing with Zoom. Zoom, as you can see, has this kind of this bullish trend line that it's been trading every single time it tags it. You have a very nice run to the upside. You tagged it again yesterday. It's yet to see whether this continues to move higher, but there are some concerns here because, as you can see, as markets continue to move higher, momentum continues to move lower. So that's a concern here. So there may be some opportunity potentially for some shorts here. These are some of the things that we go over on our Tuesday and Friday morning sessions. So I hope that you guys are able to join me for that. We have our next one tomorrow morning. But until then, let's take a look at some of your questions that you guys submitted prior to today's session. We're going to take a look at your questions here. So a lot of questions regarding the Goldman trade, a lot of questions regarding the target trade. So I'll cover both of those first, and then we'll jump into the other questions. So first, let's talk about the target trade. This was a options action trade that I posted 2 weeks ago on earnings. I was expecting target to beat on earnings, very similar to a lot of the other names that we were currently looking at in the retail space that has a very strong digital strategy. Similar to Dollar General that we saw earlier in the season, similar to Amazon. Target actually beat earnings, had a very good earnings from a tech, especially from the digital perspective. Their numbers from a digital their new digital strategy was particularly strong. And what I loved about the earnings report was that not only was the digital numbers very strong, it didn't cannibalize the physical store sales. So they actually saw an increase in physical stores as well as an increase in digital sales, but the stock did not move higher. It actually continued to move lower. Now, I know we put out a trade to get out. We put out a closing recommendation on this particular trade. The stock has rallied quite a bit over the last couple of days since then, especially for those of you that closed it out yesterday morning after we put out the note. You probably were able to get out of it at a slightly better price than what we had quoted. If you got out today, you would have close to gotten back to break even here because the stock is currently trading above the break even price on the option strategy. So I don't know how many of you are still in it. If you are, you can type yes into the chat window just so I know, but I know it's quite a bit of you did actually get out either at a profit initially, or you are still holding on to it right now. So it's just above break even. It is still above that 20-day moving average, which is good, both on a daily and a weekly basis. So you may get a push higher tomorrow, and that might be the, I wouldn't hold it beyond, well, actually it expires tomorrow. So, I think it's time to get out of this trade. Hopefully, if you were able to get out of it at a small profit. Okay. Now, Goldman Sachs, this is a trade that was a yield play, meaning if you look at 10-year yields, it is, as you can see, it has been predominantly stuck in this range between roughly 50 basis points and 70 basis points over the last few weeks. And when yields are this low, guess what? Banks cannot make much money. They could barely make money when yields were this high in the 1.15, 1.7 range. But when they're at 70 basis points, it's very, very difficult for these names to make any money. And I specifically tried to pick a name, Goldman Sachs, that isn't particularly strong as a stock. If you look at Goldman Sachs, it really has predominantly underperformed the markets for quite a few years now. It is not a strong player. Not only is it, Goldman Sachs used to be I would say a poster child of M&A deals, of trading. They've spun off most of those businesses in terms of their very profitable trading businesses. Their M&A activity has been really slow. Their iBanking division is not particularly strong these days. A lot of that has gone over to JPM. That is the strongest of best of breed, if you will, of the banks. And when you have Goldman trying to corner their way into the consumer market through their Marcus products, they really have not been doing very well on that front either. So I was looking for a relatively weak name in the particular banks, the major banks that are very liquid, and that was likely going to have a hard time making money in a low interest rate environment. And that's why we took that short bearish trade here on Goldman, especially when it started to peak below the 20-day moving average. We were looking for this stock to start rolling over here, especially in financials being the weakest sector outside of energy prior to this recent rally. So I was a little surprised to see this initial rally here this week. caught us by surprise, and that's why we cut our losses here this morning. We cut our losses because that's our general rule of thumb on credit spreads, is that when you lose more than 100% of the premium that you collect, you cut your losses. Now, I know quite a few of you emailed me on this, quite a few sent your comments on this particular trade, but this is a trade that some of you are still holding from the emails that I've received. And certainly we saw a lot of weakness into the close. So if you're still holding on to this, you are certainly in a better position than where we were this morning. I'm not, I will say that if I wasn't just closing out a Goldman trade, I actually think that this is a pretty attractive time to get into a short trade again. But again, because I just got out of this trade, I'm not going to get back in. I usually don't like to do that. But for those of you that are trying to, maybe you never got into the Goldman trade, I actually think now might be a good time to short. We have a severely overbought condition here. I would say that ideally you would have gotten in near the top around 208, 207. If you didn't, I still don't think it's necessarily too late. You might still get a pullback down to maybe that 190 level or so. But that's the trade. That was the thesis behind the trade. We were wrong, and we got out of the trade very quickly as a result of that. But for those of you that are still holding on to it, maybe hoping that Goldman comes back below 200, I think you might have a shot at that and get out at a smaller loss than we did here on this particular trade. So a lot of questions. I think there was, out of the 50 or so questions that I got that were submitted, almost, a fifth of them were related to either Target or Goldman. So I'm glad I was able to spend a little bit of time, walk you through why we got into those trades, what went wrong, what went right, what didn't go right, so that you guys can use this also as a lesson to learn. But the important part in this current market environment is that no matter what type of trade that you do it with limited risk. Now, Goldman wasn't, we never intended on staying in this trade for very long, because any type of short trades in a very bullish market environment, generally speaking, does not work out very well. You are looking for a quick move to the downside, and you're looking to take profits quickly. It didn't materialize. Trade went against us. It's time to get out. S&P 500 is breaking out. This is something that we've been covering for quite some time, as 295 is a major resistance level. The fact that we've broken out to the upside is extremely bullish. And because 302 goes back to a pretty substantial number here, which is if you look at this line 302, that was the late July resistance level. It was a resistance level again here in September, and we finally broke out above that in November. So this was a major resistance level for us to get back above. And think about all the people, all the investors that had consolidated and bought stocks between all the way from April all the way to November. These investors, remember, these are investors that were underwater all the way during this time, meaning if you had bought some stocks up here, you were waiting for this rally to get back to these levels so that you can sell your stocks. And the fact that we were able to get back to these levels and break above that 302, that's an extremely bullish, I would say, outlook on the current markets. Now, today, the price action weakened quite a bit. Let's see if we get a bit of a pullback before it starts to move higher. But my indication is I think that the markets may get a small pullback, break out higher, and you're going to start to see markets continue to resume this move higher. That's our base case at the moment. Again, for those of you that joined us Tuesdays and Friday mornings, you know that our base cases are changing all the time because of new information that's coming in. But at this point, that's been our base case for a while now, and it has worked out fairly well. That what you want to do is when the markets dip, those are opportunities to buy. We had a little bit of that on Tuesday morning, when even though markets opened higher, a lot of technology stocks opened substantially lower, and that was an opportunity to go long. Let's see if we're going to see some of that type of opportunity in the next couple of days as well. So let's move on to some of the other questions that were submitted. Let's see. First three were all on Goldman or Target. Let's see. There's one here by Joshua. Joshua is asking, are there options trades that will work when you believe a company's earnings will cause a significant move in one direction? It seems like we usually avoid earnings dates on options trades. So I will say that every single trade that I've done on options action for the last 7, 8, maybe 9 weeks have all been earnings plays. So I don't know that we necessarily shy away from trading earnings, just that I've had my fair share of earnings from my options action trades. I will say that if you think that a stock's going to make a big move to the upside, an example of that is, let's say, PayPal, right? This was one that we were very very bullish on. And the great thing about, if you think that a stock is going to make a big move to the upside, well, actually, let's take a look at a name that's actually reporting. Let's look at Zoom. Zoom reports next week. This is one of my favorite ones. Okay, so I did a Zoom trade. This was my best performing trade on options action, about 1,000% return on a calendar that I turned into a vertical. But if you are very bullish on a stock like Zoom and you think this stock is going to beat it on earnings on June 5th, it's a simple strategy. You just simply buy a call option. That is the only strategy to take if you think a stock is really going to blow it out of the water on earnings. And generally speaking, I would buy just a couple of weeks after the earnings announcement. So here's it's June 2nd rather. It reports earnings on June 2nd. I buy a June 19th, which is the monthly option, and I would buy, usually with something like this, I would buy the first out of the money option, maybe the 165. It'll cost you a lot here. And this is really one of the challenges with trading Zoom. I was actually really, it was actually a really difficult trade to trade here on Zoom, my first one, because it was so expensive to buy the stock. And this was kind of before COVID-19, before we kind of had an idea that things were going to take off for these types of stocks. Now, I'm still quite bullish on this particular stock because I think working from home is going to be a trend that's going to continue for quite some time, substantially longer than I think we anticipate at the moment. So buying a 165 call costs $13.50. That means my break-even price is $178.50. If we look at a chart here, $178.50 is basically the all-time high. So you basically need the stock to go to the all-time high and higher just to break even. Now, if you look at stocks like PayPal and you say, well, if PayPal can jump from 128 to 141 on earnings, then maybe Zoom can do the same thing. So you might say, well, what happens if Zoom, currently trading at 162, jumps back up to 180 or 185? And this is something that you can utilize our P&L simulator to say, well, what happens if Zoom jumps up to 185 a few days after earnings, let's say on June 5th or so, and we know volatility comes down a little, your call option will be worth will have a 65% return on your capital. So buying a call option or a put option is the simplest way to take a bullish view on a individual name going into earnings. Great question, Joshua. Ashok is asking, hi, Tony, I'm a new subscriber. My problem is that only one of your trades filled at TD Ameritrade at your suggested midpoint. Rest stayed open and expired after 2 days. What should I do to get the trades filled? So great question. So generally speaking, that hasn't been my experience when you're trading names that are on the very options, the very liquid names. I've been pretty, and keep in mind that when you say the midpoint, I hope you mean the midpoint at the time that you enter the order, not necessarily the midpoint that we quoted the night before. So for example, if let's say we quote you this call spread at let's say $10.20, right? So the premium here is $10.20. That's the midpoint. You can't necessarily just enter $10.20 and expect the next morning's open to be at $10.20. If tomorrow the market opens at $10.50, then you want to place your midpoint at the opening midpoint, so that, because then you have a much better chance of getting filled. So Ashok, just remember that when you're entering your orders, you have to look at the midpoint at the time you entered the order, not necessarily the time that we looked at that trade. So I have generally found, well, I will tell you, I enter all my orders at my midpoint. I either get filled at my midpoint or I don't get filled at all. And I would say that I get filled on probably 80 to 85% of my trades, but that's predominantly because I trade only the names in the very liquid names. I know for a fact that I should be able to get filled pretty easily on those names. So Ashok, I hope that answered your question. The next question is similar to this. Drew asked, How does liquidity affect the value of an option? You mentioned in previous webinars that you would not buy most options because of lack of liquidity. So that is true because we know that there are about 4,200 symbols that you have options listed on, yet my options liquidity list here has only 277 names, which means that there's roughly 4,000 optionable symbols that I would not touch. I wouldn't even go near it because the options liquidity is simply not there. So the question though is, how does liquidity affect the value of an option? Now, the value of an option actually doesn't get affected at all based on liquidity because the value of an option is simply just a function of the stock price and the volatility of the stock. So how much time is left till expiration? How volatile is the stock? And where's the current stock trading at? That's what determines the value of an option. Now, liquidity will change a different thing. So let's say the midpoint on this call option right now is $13.20. You can think of the midpoint as the value of the option. What liquidity affects is how wide the bid-ask spread is. So here the bid-ask spread is 30 cents away from the midpoint, right? So you have $3.20 and $3.50, $3.20 and $12.80. So the liquidity of an option does not affect the value of the option. What it affects is how wide the market makers are willing to buy and sell at. So if something's less liquid, you might see this quoted at $15 by $10, where the value of the option is still the same because the value of the option is not based on liquidity, but the prevailing prices at which market makers are willing to buy and sell from you are going to be substantially different depending on liquidity. So I hope that answered your questions regarding how options liquidity affects the value of an option. Usman is asking, would love to see your process on how to evaluate certain tickers before a position, i.e. your daily plays. What do you look for? Technical analysis and the fundamentals. Great question, Usman. And I think there was another question below asking, I'll try to find it, but someone else asked, I think, a similar question. If I find it, I'll make sure I address it. But Usman's question is, how do I go about deciding what stocks to trade? So I will say that we always start with a significantly smaller portion of the. So first of all, what we do is we've built some automated scanning on our end that only looks for stocks within the very liquid names. And what we look for is very specific technical analysis patterns within these 163 names or so. That brings that 163 list down to usually in the 20 to 30 range, where we're looking for some bullish names, we're looking for some bearish names. I always like to start by looking at the overall market. Number one, meaning am I bullish or bearish on the market? Currently, I'm bullish on the market. Then what I look at is specific sectors, and we actually have this built for you inside of our watch list. Our sector portfolio, our sector watch list, what it does is you can sort it by the score, and that tells you which sectors are strongest and which sectors are weakest. So the strongest are the ones with the highest score, which is the technical score here. The consumer discretionary, technology, and communications are the strongest sectors at the moment. Financials, energy, and industrials are the weakest sectors in the moment. So when we're looking for bullish opportunities, we always look within the strong sectors. When we're looking for weak opportunities or bearish opportunities, we always look in the weakest sectors. That's why we pulled the trigger on the Goldman Sachs, because it is the weakest sector at the moment. We only like to short stocks in the weak sector, and we only like to go long the stocks in the strongest sectors. So we always first have a top-down macro view. Where's the overall market? Where are the individual sectors? Then we start taking a look at individual names. And predominantly when we're looking at individual names, what we're looking for are stocks that have made a bit of a counter move in a larger, broader trend. So if you look at a stock like Zoom, it's clearly in a bullish trend. What we're trying to identify is when the stock makes a bit of a counter move and has a high probability of that stock moving higher. So what we're really looking for is what we call, some people call it a slingshot trade. There's a lot of different names for it, but the idea is to find something that has moved lower in a broader trend that has a high probability of moving higher. These are the types of names that we're looking for. So just to give you an example, Tractor Supply, what we did is we went long on this particular name because as you can see, we were in a very clear bullish trend, but when the stock, as you can see, this RSI pulled significantly below its average, which is that blue line, and that was our indication to go long Tractor Supply. And what we do is we also, once we find this type of trade, there's a few other things that we have to do. We have to, number one, see, is there an options play on this particular name? Is the fundamentals of this stock aligned with our views? So Tractor Supply is obviously a consumer discretionary name, so it lines up with our consumer discretionary strength in terms of sector. We were able to find a strong options play on that. At the time we found the call spread, I think it was the 108 120 call spread, and we said that this is a stock that has, you know, strong earnings potential. This is, you know, if you look at the stock, this is a name that we've actually quite liked for a number of years now, because they are the only supplier for a lot of these rural areas, you know, where Walmart and Target and Amazon don't really reach. A Tractor Supply is the only player in that particular space, so they have a very nice moat, as Warren Buffett would call it, in terms of their business. So there were a lot of things that really lined up about this particular trade. The fundamentals look really good. The technicals had a very good timing on it, and we were able to find an options trade for that. You know, there's a lot of things that have to line up for it to become a daily play, but this is an example of one that I think worked out really well. So I hope that answered your question as far as how do we go about selecting our daily plays. There was one other question similar to that, so I hope that answered both of your questions. The next two questions were about Target, so I already covered that. Barry's asking, in this high quality market with inflated option prices, what's the best credit spread strategy? So I will say that, you know, as far as credit spreads, you still need to have a directional view, right? And at this point, our directional view, I think, is pretty clear that the markets are on a bullish trend. You look at S&P, you look at Dow, you look at NASDAQ, you even look at small caps. IWM has been participating on this particular rally. So you have broad participation on this rally. VIX, you know, despite being fairly, I would say, stable over the last couple of days, despite markets rallying, it's certainly below 30. So we're seeing some stability. It's still well above, you know, previous highs, right? So if you told me back here in all of last year in 2019 that we'd see VIX at 30 and stay at 30, I would have told you you're crazy, because VIX has predominantly been in the teens. So we're still at very high implied volatility compared to where we were last year. So credit spreads make a lot of sense. So when we're looking at credit spreads, what we prefer to do is wait for dips and sell put credit spreads. And these were some of the things that we discussed here in our session last week, which was the fact that put credit spreads have an edge over call credit spreads. They have an edge for two primary reasons. Number one, markets move higher about 55 to 60% of the time and move lower about 45 to 40% of the time. And this was actually some of the research we conducted last year. We published this, where if you look at prior to, I would say, 2018 or so, the numbers were pretty much 55% days or weeks the market moved higher, 45% of the time the markets moved lower. So that's 55% higher, 45% lower. And that number has predominantly stayed for quite a few years, going back to 1999 when we did this research. And then what we notice is that in the recent past, starting about 2008, 2019, that number skewed towards 60% days or weeks when the markets moved higher, and only 40% of the time the markets moved lower. Because what ended up happening was that markets, when they move lower much faster. It didn't last very long. They moved more violently, but they didn't last very long. But most of the time, the markets were just eking their ways higher, and any moves you saw to the downside were very, very short term. So what that means is that the just due to new probabilities, you have a better chance of making money on betting that the stocks are going to move higher, because 60% of the time markets move higher, only 40% of the time move lower. And if you were able to capture that using high volatility in this particular market environment, so an example of this, and I'll just use an example like we had today here on NVIDIA. NVIDIA, let's see, let me just show you a chart. if we look at NVIDIA has this type of counter trend thing that we were talking about, right? You have the strong bullish move and you've had this recent sell-off down to the 20-day moving average. And this is kind of the buy the dip mentality, if you will. When the stocks dip from that 367 down to 336, that is an opportunity to potentially play for a move to the upside. And what you're trying to do here is you're trying to find a put credit spread that you can sell that can generate a fair amount of premium. As Barry said, we're in a high quality market with inflated option prices. Inflated option prices is correct. So if you sold something like a 340, 320 call spread, this is a $20 wide call spread. I'm sorry, put spread. If you think about normally on a credit spread, we're trying to collect 1/3 of the width, right? So 1/3 of $20 is $6.60. But here, as you can see, I'm collecting $8.45. So I'm collecting almost $2 more than what I normally would achieve in a credit spread like this. And this is the type of market environment that we're in. And most of the credit spreads that we've sold over the last few weeks have predominantly collected close to 40% of the width, sometimes even a little bit more. And we've been able to get filled on these. Normally, we would never get filled on 40% of the width here. So you have a lot of opportunities to generate premium. You're collecting, you are taking on substantially less risk selling put spreads in this type of market environment than you normally would, because normally you're risking twice the premium that you collect. Here, I'm risking $1,100 on $845 in potential income. Normally, I'm collecting about $650 and I'm risking $1,300 on a credit spread like this. So right now, when things are quiet, when things are stable, now is the time to sell put credit spreads like this. You can find call credit spreads that collect quite a bit of premium as well, like our Goldman trade. That was the type of risk reward that we wanted to take, so that even if Goldman blew it out of the water, we were only risking no more than 150% of the credit that we received on that particular trade. So Barry, I hope that answered your question. Let's see. Per asked, how do you find opportunities in the, here, that was the other question. How do you find opportunities in the ocean of stocks? What is the technical setups you use? So I will say one of the things that really helps us whittle down the ocean of ideas down to a few is this options liquidity list. You know, instead of scanning thousands of stocks, so any of you that use scanners in your trading, right? You know, you're scanning thousands of stocks. And sometimes, you know, if you're looking for a specific technical setup, you might find hundreds of stocks meet that criteria. So first of all, by only having a universe of about 160 names, it means that from a technical perspective, I'm not looking at hundreds of ideas. I'm really looking at maybe 10 to 20 ideas to start with. So we already filter out most of it using liquidity. Then we look at technical analysis. And if we look at the technical analysis, there are only so many stocks that are in the communication technology and discretionary sector if we're looking for bullish ideas. And there are only so many industrial, energy, and financial names in our bearish ideas. So usually at this point, when we're down to looking at specific names, we're not looking at that many. We also have some scanning capabilities that we've built to give us a sense for where is options giving us an edge. We look at that first as well. So these are the different things that we look at in our trading. And only lastly, do we look at the fundamentals. Do we say, okay, we have a bullish thesis here on this trade. We have a spread that makes sense. Do the fundamentals line up with this view? Now, generally speaking, I would say the liquidity list doesn't change a whole lot day to day. So generally speaking, the fundamentals of a stock, I kind of have a bit of a view in my head already on individual stocks and individual sectors. So only if it's a new name that I'm not familiar with, that I haven't looked at in a while, do I do a lot of deep dive on the fundamentals. But as far as fundamentals go, predominantly what I'm looking for is growth. I'm looking for sales growth. You know, we don't want to just see price growth on a stock, because many times you can have stocks that, you know, continue to go higher because of share buybacks or high dividends, and they're not really growing from a sales perspective. So sales growth is first and foremost, because you can't manufacture sales growth unless you are one specific Chinese coffee company, but otherwise you can't manufacture sales, and that is really the main thing that we're looking for. If we're looking for bullish opportunities, we better see a stock that has seen a pretty substantial growth in terms of sales and a steady amount of growth in terms of sales, and vice versa. For bearish trades, we want to see a stock that's seeing declining sales or declining revenues. So I hope that answered your question there. Mohammed is asking a question, where to find Delta? So you can find Delta on any of our platforms by clicking on the blue button here on any strategy, and you can click on explain strategy and Greeks. We actually calculate for you the net delta also on a spread as well. So if you're thinking about a spread, you can calculate delta here. And this is really one of the ways that you can really see why many times I don't like selling these really high probability trades. Sometimes people like to sell these really high probability credit spreads that have 70, 80% probability of profit. But as you can see, the deltas on them are pretty low. And that's generally speaking why we don't like to sell these types of debit spreads like that. But you can see your Greeks by clicking on the blue arrow and click on explain strategy and Greeks. We have both delta, theta, gamma, and vega, and we express it to you in plain English as well. Raghav is asking, do we never care about gamma when placing trades? You only talk about theta and delta when placing trades. So great question. So we certainly did cover gamma during our beginner options trading course. We actually talked it a little bit about in our beginners options trading course where we discussed debit spreads. So it absolutely is something to be aware of. The only thing about gamma is that it doesn't really kick in unless you're talking about at the money options. They're about 1 to 2 weeks from expiration. So if you're not trading options that are at the money, near expiration, gamma is relatively small. But we do talk about gamma in terms of how it changes your delta, changes your leverage ratio on a specific options trade. So that is something that we do cover on our beginners options trading course, in the course that we covered on how to add leverage to your portfolio utilizing options. So if you want to review that, Raghav, please go ahead and watch that recording because we do cover that. Sunny is asking, please show how to trade iron condor using your website. So you can certainly trade iron condors here. I will say this is not my favorite strategy, but you can use the strategy constructor. You can click on neutral and you can select short iron condor. You can use put condors as well or call condors. We used a similar type strategy on Macy's, but we used a butterfly instead of a condor. But we built this actually specifically to allow you to quickly be able to change the wingspans, the moves the strikes up one, down one by the click of a mouse. So you have a lot of functionality here to allow you to trade iron condors if that's the type of strategy that you want. We actually have a lot of strategies under our strategy constructor. You can construct them using just by the click of a mouse using OptionsPlay. Dave is asking, when will OptionsPlay be able to track our personal options trades, much like you do with the portfolio section? So this is something that we are currently working on right now. I have a whole team working on this portfolio section. We have an update to this right now. So I hope to be launching that here very soon, Dave. Kelvin saying, could you please explain the average return on capital on the OptionsPlay strategy performance sheet? Is it monthly, year to date? What is the time frame? So Kelvin is referring to this spreadsheet that you guys can access that is published with your daily play emails that's sent out to you every single morning. And I think he's asking, how do we return this? How do we calculate this return on capital? The return on capital is simply based on the amount that you invested, meaning the capital requirement that it took you to get into the trade and how much you got out of that trade. So it's not annualized. It is not over a specific time frame. It's only over the time frame of that specific trade. Bobby's asking, how do you determine if a credit iron condor strategy was good for an underlying? If an underlying moved to either short strike before expiration, what's your plan of action to manage the trade? So if you think about an iron condor is really a put credit spread and a call credit spread merged into a single strategy. Now, because your net delta on an iron condor is effectively close to zero when you enter the trade, you really have very little directional exposure. Your only real exposure is to short vega and short theta. Those are your two main primary components to a iron condor. But as the stock starts to approach your short strike, so if the stock starts to move, let's see if I do this. If the stock starts to move from here to here or here to here, that's when you start experiencing some deltas. And that's the difficult part about trading an iron condor, but it's the same problem that you have with selling a put credit spread or a call credit spread, is that the trade starts to work against you and you have to figure out a point at which you want to cut your losses. But I will say an iron condor by definition has limited losses. No matter what happens, you know what your max risk is on an iron condor. So you should have some sense as far as when you want to cut losses. So let's say this max risk on this particular trade is roughly $1,200, $1,255, you should say to yourself, if I lose $600, $700, or some point roughly about maybe 50% of the way, maybe 60% of the way, you basically say to yourself, if I lose $600 on this $1,300 trade, I'm going to get out and take my losses. That's the best way to manage these types of trades. I don't know. I don't know of a better way to potentially manage these trades. Andy's asking, what is the optimal time to close a vertical if you're making profits or a loss? Difference between buying a call vertical versus selling a call vertical. So to answer your question in reverse order, yes, there is a difference between whether you're buying or selling a call credit spread in terms of whether or not you're going to, how to manage those trades. I will say debit spreads are much easier to manage in my opinion, because the rules for exiting the trades are to enter or exit the trades are the same regardless of what kind of debit spread that you're trading. But if you're selling a credit spread, then that's where it depends on how much premium that you're collecting. So if you're collecting 1/3 of the width, then there's just one set of rules. If you're collecting less than 1/3 of the width, there's a different set of the rules. And those are actually some of the things that we covered on our credit spread session, where we talked about if you collect less than 1/5 of the vertical spread, you want to cut losses at about a 100% loss, 100% of the credit that you received. But if let's say you only collected less than 1/5 of the vertical spread, so on a $5 wide credit spread, let's say you collected 70 cents, then you want to cut your losses at about 200% of the credit that you received. So credit spreads, a little bit more work in terms of managing them, depending on what type of credit spreads you sell, but there absolutely is a difference in terms of whether you're buying and selling. And there's also a difference depending on whether you're making a profit or taking a loss. Because many times if you're making a profit, you might want to roll that position, meaning lock in some gains and continue holding on to it for more, versus when you have losses, generally speaking, you want to just cut your losses and move on. So I hope that answered your question, but if you have a follow-up question on that, Bobby, that was Andy, please send me an email at info@optionsplay.com. I'm happy to take a look at that. How to read support and resistance lines below the chart. The support and resistance lines are simply telling you where the next support or resistance level is. There's really not much more to it than that. Sergey is asking, on credit spreads, you suggested selling a 50 delta and buying a 25 delta. So I was looking at a bull put today on DocuSign, and the 50 delta deep in the money. And the 50 delta is deep in the money. Not sure if I understand that that's selling the deep in the money call. So I think what you're referring to is the fact that DocuSign is a very volatile stock. So the 50 delta tends to be is actually in the money. So I will say this is an example where you would have to adjust that and move that short strike to the at the money strikes. That might be a 45 delta in that particular case. I will say this is unusual. It's because we're currently trading in a substantially much higher volatility environment than we normally are. Usually we think about the 50 delta as the at the monies, but right now here's where we have a scenario where sometimes the 50 deltas could be $5 in the money, especially on a stock like DocuSign, where it's trading at $127. You might find that the at the money is at 135, or I'm sorry, the 50 delta is at 135. This is not normal, but I will say then you would just adjust your strike prices to sell maybe the 127 or 128. So hopefully that answered your question, Sergey. Leonard saying, Tony, what's the reason that you stayed with Tesco trades so long? In your seminars, I recommend you said you recommend to exit the trade at a loss when it gets to 50%. Leonard, I unfortunately think that you may have entered that trade incorrectly, because the Tractor Supply trade is actually profitable right now, not unprofitable. So I'm concerned that you may have entered this call spread as a bearish trade as opposed to a bullish trade, because that's why we held on to this, because this trade is still profitable. And lastly, Sonny's asking, I have a QQQ debit July 10th call spread, 231, 252, that is working well. In what position should I exercise the calls to hold on to QQQ shares? I'm guessing you are long. Hold on, let me just check this real quick. I'm not sure if you're long or short this call spread. So Sunny, if you are on this webinar, please send me an indication as far as whether you're bullish or bearish. I'm sorry, whether you've bought or sold that credit spread. Okay, so those are all the pre-selected questions that people sent us here today. So with that, I'm going to try to answer a few more questions, but I have to wrap up here in a few minutes here. So let me try to answer a couple of questions that came in while I was talking. How do you do various levels of liquidity? So I think I've already talked about that. Those are based on bid-ask spreads. How many strikes with large OI? There was a lot of questions about liquidity. So I want to address this again because I seem to still get a lot of questions about this. What's the best way for me to display this? Let's see. 1 second. So I get a lot of questions regarding liquidity from people saying that, you know, they're looking at an options trade and they see that the open interest on an option is relatively low. And what they're not sure as far as, 1 second. So I've gotten a lot of questions from users saying that the open interest on an option is very low. How do I get into this trade, or why should I trade something with low open interest? So let me find a, let's see. Okay, here's an example. So here's Zoom going out to, let's say, the July 10th or the July 2nd or even the June 26th weekly options. And what you'll see, the open interest here is relatively low, right? 0 here for the June 10th, just a few contracts here for June 2nd, a little bit more for June 26th. But if you look at the June monthly options, as you can see, there are thousands of contracts available in terms of open interest. And the question that I got from users I get a lot is, you know, I'm trying to buy this call option. You know, I want to buy the 162.5 calls on Zoom, but the open interest is so low. How do I place this trade? The answer is you place the trade the exact same way as you would any option that has a high amount of open interest, because the only thing that matters is whether Zoom stock is liquid or not. It has nothing to do with open interest. Open interest has nothing to do with whether you're going to be able to get in and out of this trade. So I want to reiterate again, in the world of electronic market making, they have now listed thousands and thousands more strikes than they used to, because market makers are no longer holding a piece of paper and making markets manually. They're doing electronically, and the computers can make markets across millions of strikes and expirations. That's why they've listed so many. That's why you have so many strike prices available to you. That's why weekly options are dollar strikes on all the big name stocks. They used to be $5 wide. So naturally, when you list so many strikes, there's going to be lower open interest per strike, but that has nothing to do with liquidity. So don't be afraid to interact with the quote when you see something with 0 open interest. You know, I get a lot of questions about this, but I don't know where this came from, where people were afraid of entering orders because of low open interest. Maybe you had a bad experience, but you know, in the new world of electronic market making, that's not a problem anymore. You know, the 152 Junes or Julys are not any less liquid than the 162 monthly options that have, you know, thousands of open interest. So what you do want to take a look at is how much open interest is there across all of the strikes, right? So if you look at all of the strikes and you see there are thousands of open interest, that's what matters. Because if you pull up a name that where across the entire spectrum there are only 20 contracts, then you know that it's not a very liquid name. But I will also guarantee you that will never make it on our options liquidity list. So keep that in mind. All of our options liquidity list are options that you can get filled at the midpoint, regardless of what the open interest is on a specific strike. Let's see. Are you using Bollinger Bands or Keltner channels? No, I don't use any of them. I use very simple indicators. I use a 20-day moving average or a 20-period moving average, and I use an RSI, 14-period RSI, which I put a 9-period moving average on my RSI, but that is it. Why not buy bull put spread on ZM? You certainly can. I think my only concern was the fact that today's price action, got all the way up to 169, but closed at 163. That's a pretty weak price action. That's usually a concern to me to see that type of weak price action. Could you please recall us the link to liquidity sheet? The liquidity sheet is already on your OptionsPlay platform. It is at the bottom of your platform right here where you click on liquidity. Let's see. I'm going to try to get to some questions here. Do you essentially need to own the underlying security for calendar spreads? No, you do not need to own any securities to do a calendar spread. What are the risks of any kind of this trade without owning the stock? The risks are really not much different than a long call, because you've hedged your risk on the short call with the long call. So it's similar to a cover call, I would say. The only difference is that a calendar spread has far less risk, because even if the stock drops to zero, the most you can lose is what you paid for that calendar spread. Could you please discuss selling calls against leap options? So that's exactly the same as a calendar or diagonal spread. You're just selling a short-term call against a long-term call. The difference on this, especially regarding potential for assignment, is that when you get assigned on a cover call, you just give away the stock that you own. When you get assigned on a calendar or leap, you have to then exercise the long call in order to satisfy that assignment. So best thing to do, in my opinion, is that if you get assigned on a leap, is to simply buy back the stock on Monday morning. Because if you exercise a leap, you're giving up all the extrinsic value of that leap, and you don't want to do that. What is the link for covered calls? So that is a link that we send out every single morning. But let me see if I can get you. It's trade.optionsplay.com/. I thought it was covered call, but I could be wrong. Nope. Let me get you that link here in 1 second. I will find that while I answer that next question. The next question, what are your thoughts of selling in the money cover calls? So I would never sell an in the money cover call. There's really no good reason to sell an in the money cover call, because you have no upside, and I don't know why anyone would take on the risk of the stock going down for zero upside. Yes, you get downside protection, but what's downside protection good for if you don't have any upside? So that's why I would never sell an in the money cover call. The bright chart is clearer than the black charts that you normally use. Okay, that's pretty good. I would say feedback that we can certainly bring back and make sure that we can. I'll try to use the lighter charts if people find that that's easier to read or that's easier to look at. I don't have the link to the cover call report, but I will find that and email it to you. So if you don't mind, send me an email at info@optionsplay.com, and I'm happy to send that to you. When you're buying the option, it falls in the liquidity list. However, when you sell, you don't know if it's still liquid. Well, I will say that the options liquidity list doesn't change that often, from the perspective of something doesn't really go from very liquid to not liquid at all in the span of a week. It just doesn't happen. So generally speaking, if you get into an option when it's liquid, chances are it's still pretty liquid by the time you get out. When closing a call vertical spread, do you choose the midpoint on weight? Yes, I always use the midpoint, and I never try to move it, because again, I'm only generally trading stocks that are in the very liquid name. If you want a recording of any of our previously recorded sessions, my suggestion to you is please go to our YouTube channel. You can subscribe to us on our YouTube channel. All of our recordings are there. And if you subscribe, you're able to get access to the where is the channel? Whoops. If only I can, here we go. I posted a link here in the chat window for you guys to subscribe to OptionsPlay. This will give you updates to all of our recordings. So I highly recommend you to sign up and follow us on YouTube. Would you say a score of 80 or more is a good trade? I would say anything more than 80 is the bare minimum that I'm looking for. Generally speaking, I want to see something higher if possible, but anything below 80 is something that I would generally avoid. When Zoom is going up, why would we not use put spreads? You mentioned call spreads just now. You can use either one. I don't think one is necessarily better than the other. You can certainly buy call spreads. But I will say call spreads, as you can see here, they are quite expensive, and they don't list a lot of strikes. They only list up to 190 on the July monthly options. You can find higher strikes. Okay, guys, I would love to answer some more questions, but unfortunately I'm running out of time here. But this is why we offered these Q&A sessions. And this is part of why we ask you to submit questions ahead of time, because that way I know for a fact that I can get to your questions during our session. So next month, if you want your questions to be answered, unfortunately, there's so many of you and there's so many questions. I really try to get to as many as possible, but unfortunately, I just simply can't. And I will try to get Michael Coe back here with us to do another session. I think many of you like those sessions. So I'm going to try to get one of those on the books as well. So again, I hope that you guys are finding this useful and helping you guys better understand as to how to frame your options trading, as well as where the current market is headed, and giving you a little bit of understanding as to how we go through our process to select these trading ideas for you and show you how we are managing these trades as well. So I think that that's insight that a lot of places don't provide, and that's why we're here to try to provide a little bit of time so that you can see how we do our work. So with that, I want to thank everyone for taking the time out here this afternoon. I will say that for those of you that are members, I thank you so much for your support. If you are not a member, I really encourage you to consider supporting us to allow us to continue building on our platform, building our education, and hosting these educational sessions to help you better understand how to trade options and position yourself in your portfolio. Membership to OptionsPlay is just $75 a month or $500 a year, and you can sign up using the link on your screen. So thank you so much for supporting us. I hope you have a great afternoon, and I'll see you guys here tomorrow morning for those of you that are joining us for the Friday morning sessions, and on TV tomorrow evening for those of you that watch CNBC Options Action. Thank you so much. I hope you have a great evening.